Good afternoon, everybody, and welcome to the summer solstice edition of Bull Sessions. My name is Mark Robertson. I'm joined here by Ken Kavula and Kim Butcher. Ken is in central Michigan, and Kim is in south central Florida. Good afternoon, guys.
Good afternoon, everybody.
Hi, everybody. It is the sauna here. Heat temperature is 102.
And we have a really good autumnal chill here in Michigan.
I don't know what it is down there, Mark, but it's 62 out here right now.
Oh yeah, I'm showing 60.
Yeah.
So that's pretty rare, especially since we were pushing up on 100 degrees just a couple days ago.
Yep.
But anyhow, so I have been without power for the last day and a half, and I went through the full on experience of withdrawal and concern as to whether or not I'd actually be able to figure out how to get back online. And there are no Starbucks and McDonald's to turn to in the neighborhood, and I didn't know. So I am grateful that we were able to at least get some level of service restored. And if I disappear, we'll see you next week. But things seem to be going okay for right now. Today's program is going to just simply take a kind of a timeout moment to do a little Cleveland-esque rock and roll roundtable halls of fame and shame. Parentheses humility. That's just a reference to how some of our best ideas can lead to humiliation by the great humiliator known as the stock market. But it is kind of interesting to take a look at some of the ideas that have been propagated by the round table. And every once in a while, Ken and I will scratch our heads as to why we didn't double down or go back and return to one of those one-hit wonders, and we'll probably kick a few of those around. To this day, Ken, I don't understand why we never went back to TJ Maxx.
Well, I pondered that back and forth, and I finally kind of came to a resolution about that by saying to myself, our original idea was to come up with new stock ideas every month. So that's the way I kind of rationalized it in my own head.
If I'd been wrong, guys, I shop there quite frequently. I would have said, oh yeah, let's go back to this one.
Well, yeah, and that is the premise behind the round table, but it also does make sense to demonstrate the accumulation of existing positions too. So we actually do both of those things, and that's some of what we're going to talk about here today. We're also going to give that update on Apple. Apple is part of the issue 7 update, which is the current weekly update for Value Line, and it still does rank as the #1 stock that is most widely followed on dashboards by Manifest Investing subscribers. So it continues to hold down that position, so we'll talk about it. And then the last there is a sandcastle. I just like sandcastles this time of year. All right, let's go ahead and get the legal paperwork out of the way. No investment recommendation is intended. This is all about education. Everything that we do here is an illustration, or even more so, a demonstration of the philosophies, techniques, and methods of the modern investment club movement, as championed by either Better Investing, the National Association of Investors, or Manifest Investing. Everything that we express here are opinions. We do try to remember to share when we actually have a stake ownership in a company that we talk about. But please do your own homework and make your own decision. Don't run out and buy something because it shows up digitally on one of our pages here today. We do a monthly roundtable. That is coming up next Tuesday. The roundtable is a group of 4 or 5 friends who come together and share ideas and demonstrate the analysis of some of their best ideas over the years. We've been doing it for 11 years. The rate of return on the selections made is approximately 19%. So we've actually had some pretty good ideas over the years. If you'd like to be added to a reminder list for that roundtable session, please send an email to nkavula1@comcast.net. If you would like copies of slides, or if you have follow-up questions or suggestions for future topics, please send an email to markr@manifestinvesting.com. Anything you'd like to add, Ken?
Nope, I'm ready to see the rest of the slides today, Mark.
Okay, we are rolling then. Again, here's our bullpen, our cue. We do like to cover a number of topics, and we will be tackling some of these. I already told Ken that I didn't want to tackle inflation without him last week because he was meandering around on the roads of northern Michigan without our permission. He just took off and went and had a couple good days up north. Commendable behavior, Ken. Commendable.
Thanks,
It's
Mark.
great.
We're gonna
It's,
try to keep doing it too. I'll tell you.
it's great for mental health.
Absolutely. And Ann Manning, we do take your suggestion on the alert algorithms to heart. That will be a feature of an upcoming session. And we'll cover a few of those other topics as we can. But today we do want to talk about these one-hit wonders at the roundtable, that monthly discussion. And we'll take a look at Apple per the most recent update and the Manifest Investing 40, which is our collection of the 40 most widely followed companies at Manifest. Those topics over on the right-hand column, I continue, it's a partial list, first of all. I just find many of those things to be compelling. When I look back at things like Ken bringing the Jim Cramer's COVID-19 index, which had a heck of a run, and when Hugh and I were talking about companies like Amazon and Tesla, in fact, we'll be talking a little bit about Amazon later in a few minutes, but some fairly interesting topics, including our favorite books on investing, and we hope you're enjoying these, and we do hope that it adds to our collective investing experience. So we'll keep doing it as long as we consider that to be true. Any thoughts, Ken or Kim?
No, I just think it's great because all these ideas that we can share together helps us all. And I think each of us and our ideas, we each see things differently, and it makes us all better investors. So I appreciate you. Thank you. And Ken too.
Don't forget, folks, that you can raise your hand if you want to speak during this session. And you do have the chat box to text us in. And I'm trying to follow all that kind of stuff during the session and keep Mark appraised of what's being said in the background so that we can enter into conversation with you folks. So don't be afraid to use those two ideas.
All right, here's a quick chart for the week. What you're looking at is basically the S&P 1500, which is kind of like the value line 1700. And what Y-Charts has done here is just break it down into the three S&P Standard & Poor's index that are available for three different sizes. The S&P 500, of course, is the large cap. S&P 400 is the mid caps, medium-sized companies, and the S&P 600, denoted in purple on this chart, on both charts, are the small caps. So again, purple being small, orangish being medium-sized companies, and blue being the S&P 500, and those are all basically mega caps or larger companies. And the chart up at the top is a 5-year chart. The chart at the bottom is a 10-year chart. Just like to make the point, especially with the one at the bottom, that the S&P 500, the larger companies, have actually outperformed the other two subsets over the last 10 years. So suggesting that maybe we are in one of those modes again where it's maybe a little bit, it might be prudent to have a little bit less emphasis on the S&P 500, a little more emphasis on the small and medium-sized companies for now. That's true in the 5-year chart. That's also true in the 10-year chart. And again, with the overall reminder that we don't invest in markets, we don't invest in sectors, generally, and we simply go out there and find the best companies. And so again, not investing in markets, so going out there and finding companies. However, with the notion that maybe it would make sense to keep the radar screen wide open for the medium-sized companies. I don't remember the last time that the medium-sized companies have actually been this far below the other two, Ken. I mean, it's the workhorses they've done their job over the years, and they are now more on sale than they've been in some time.
Well, I'm looking back on the graph, Mark, and I see that there are times when the orange line has been significantly under one or the other of the graphs, but this is kind of unique where the orange line is significantly under both of the other graphs. So it's fallen into kind of third place from kind of a tie for a second place in a lot of these gap periods. But that too shall pass, it looks like, if the graph's correct. The lines tend to change position and move around. So I would love to find great medium-sized companies. And the only thing that I point out is that capitalization doesn't necessarily match the growth numbers that we're talking about. I think in these graphs, some of the highest growth stocks, the Googles and the Apples and the Netflix and the Nvidias and those companies, are classified as large cap companies, but they're growing as if they were small companies. We have to be very careful when we try to match this cap idea to our idea of growth by size of company, because it doesn't fit perfectly like we think it should sometimes.
Yeah, I would agree with that. We both believe, and I think it's worthy of really considering it, that the sales growth forecast is the most meaningful when it comes to thinking about where a company is, both in its life cycle and its field of opportunity, and in the design of a portfolio. And we spend a lot of time doing that. Whether it comes down to diversifying by size or giving some attention to sector distribution within a portfolio, the thing I've always pointed out to people who ask is that we basically never stop doing that. If you're investing regularly and you're shopping amongst all the various areas, that all kinds of takes care of itself. In fact, when you go shopping for a stock at Manifest Investing right now, you're going to find that more medium-sized companies are floating to the top of the candidate list. And it's just a natural thing. And 10 years ago, and you can go back and look at what we wrote at the time, 10 years ago, the candidates floating to the top of the list were all the S&P 500 companies, because they'd been dead for 10 years. And they were still functional, viable companies. And it just kind of takes care of itself over time.
What has struck me, Mark, in the last maybe 10 years has been the first of all, the major shift between the kind of companies that are leading the economy. I mean, I go back and I think about investing in the 80s and early 90s, and I was looking at a lot of old-fashioned, if you will, manufacturing companies that were still regarded as some of the broadest base, fastest growing companies we could look at. I mean, the GEs and the Exxons and the those types of companies that were based in a product were the ones that served the economy quite well. And with the advent of high tech, I think it's allowed a lot of companies to become much larger than a comparative manufacturing company might become, and at the same time maintain much higher growth than that manufacturing company was able to maintain. So we look at a company now that is in the billions and billions and billions, the mega cap range of as far as sales and services that they put together to make money, but the growth rates are no longer around 6, 7, 8% like they were for heavy industry. It's not impossible to see these behemoths grow at 15 or 18 or 20%. It's a major shift in the time that I've been an investor.
Yeah, and in fact, just today I added an article to the reading list at this week's update an article by Mark Andreessen where he talks about the biggest change in our lifetimes, and we're living in the middle of it. And it's tangentially related to what you just said, Ken. And he basically frames the work from anywhere situation in terms of how technology has enabled that. And not only that, some of the productivity numbers that we're beginning to see out of these companies are just staggering. And I think about, those medieval managers who thought that people had to be chained to their desks, over the last few decades. I've actually worked with some of them, and some of them are still out there, but what they're discovering is, given the right incentives and the right freedom, we can be quite a productive bunch. And that's what companies are discovering. It's fascinating to listen to some of the discussions around here, including my wife's company, they are now talking about January 2022 as maybe returning to the office. So it's really an interesting thing.
I can also say something on the flip side of that. I've got some friends who are in their late 30s, and the line that gets drawn at 5 o'clock because it's end of day, or maybe 6 o'clock, they're finding they can't get away from their computer because they're getting emails and texts that this has got to be done, and this has got to be done, and this has got to be done. So those productivities numbers could be great, but some people on how well do we have the work-life balance could really, I think, are struggling because they feel like they have to do this work, and they can't get away. They're getting emails at 10 o'clock at night. They're expected to get things done.
Well, it's definitely a learning process for everybody involved, and there certainly will be abuses. I mean, I can cite similar examples of parents at home that are able to do doctor's appointments and that kind of stuff without any disruption at all, where they might have had to take a half day off, all that sort of thing comes into the mix. But it is fascinating. I think I mentioned this also about our discussion around the bonfire a few weeks ago. These companies that are now beginning to screen and attempt to determine who can work from anywhere and who can't. Some people just aren't built for it. I mean, I've worked with people over my career that said I could never work from home like that. I just could not be productive enough. Others thrive on it. So yeah, it's uncharted territory. Andreessen's commentary is in the mode of it could be quite an inflection point or a tipping point in how things are.
I want to take that idea a little bit further, though, Mark, because I think there are unintended consequences that we're not paying enough attention to that we'll begin to deal with in the next 10, 12, 15 years. And I wonder if this sudden shift to homebound work, to work from wherever you can or wherever you want, and for however long during the day and what the hours look like, I wonder if that will tend to freeze the current leaders in their position for a longer period than maybe is quote unquote normal, and keep folks that are newer to the company, younger in age, less experienced in working in a particular job, keep them at the beginner's end of the curve for a longer period of time, because they don't have the opportunity to thrive under a potential mentor or to learn from the three people that are sitting around you in the office, or to pick up the hints and tips and tricks that make you even more productive than you possibly are right now, doing what you're doing. I wonder if those consequences are something we're going to see maybe in a longer period of time going forward. It's great right now, but does it tend to freeze everybody into the position they're in? I'm wondering if that's not a thesis that is going to start to become worrisome as we move forward.
Yeah, I think those are all valid considerations, and it'll be kind of fascinating to see how how they are responded to. There's opportunities and challenge in all of this kind of stuff. So very interesting. All right, let's keep rolling along here. Might be a topic we return to, by the way. Here's just a quick stock search. I know we like to kick out lists of companies. I figured since that graph demonstrated that some of the medium-sized, perhaps even mid-cap companies are potentially attractive, I did a quick stock search using companies that are in the sweet spot that have growth rates between 7 and 12%. I required a financial strength of 70. That's B++. That's just basically in reflecting the current condition of the market. You want a little more quality, a little more financial strength if you can muster it. Excellent quality companies. It generates a pretty interesting list. Some of those banks might be slightly overrated as results come in, but that's what we said that a year or so ago, and look what the banks have done for us in a number of our model portfolios. So there are some banks showing up in the mid-sized companies, and there's some good studies on there. Your thoughts, Ken?
Well, I was going to talk exactly the point that you made about the number of banks that make a screen like this. Almost any screen that I've been running in the last 6 weeks, Mark, seems to be heavy into regional banks. And 2 years ago, they started showing up on a lot of my screens, and I put some money into it, and I urged my clubs to put some money into it, and a lot of that hasn't gone away. If nothing else, some of these banks that have made me considerable amounts of money in the last 2 years are still pointing to par values of 14, 15, 16, 17%. We're still working under low interest rates. We still aren't at any ideal position where a bank can begin to make money the way that it used to make money. So I think a lot of these banks are operating as efficiently as they possibly can operate, and they're only waiting for the floodgates to open as interest rates begin to move up, and they're going to have to at some point. I really would urge any club or any individual that doesn't have any exposure at all to the banking system to consider it. Do some studies, read a little bit about it, and learn how to evaluate a bank. It's not some big black mystifying voodoo kind of thing to study a bank. It's pretty straightforward. There's a little bit of vocabulary you have to learn and put together, a couple of numbers that you should be able to interpret, and you could come up with a high quality bank as easily as a lot of the folks are doing right now, and find companies that are going to make you some decent profits. What on this list right here of, I don't know, 25 stocks, there's probably 9 or 10 regional banks sitting on this list. And I know I've studied 2 or 3 of them already, and they are as high a quality as manifest suggests they are.
Yeah, in fact, my Great Southern Bancorp, which is in our Run for the Roses, where you have taken a rather formidable lead. You've got First Financial, and Great Southern continues to make this list, so maybe there's a little bit of hope for me during July to catch up to in the Run for the Roses. But yeah, there's a number of good things here. I would point out that Netflix is on this list. I think it will be fascinating to see what happens with today's announcement that they have signed a deal with Steven Spielberg for a number of films committed to be released on Netflix. Might be interesting to just watch and put on your radar screen. But some good companies there. Maybe we'll add a mini workshop on asset-based company analysis here in the near future, Ken.
Well, if we expand our concept, Mark, on this list to asset-based companies, I mean, in addition to the regional banks on this list, look at the number of insurance companies on this list. There's probably half a dozen.
Yep. Good stuff. And Employers Holdings in that number 2 spot is one that I picked That's more of a workman's compensation type company, focusing on the services industry. And I was not terribly comfortable with it at the time of selection for the roundtable almost a year ago, approximately a year ago, and it's done quite well. And it still has, as Ken said, potential room to run. So fun list to dig into a little bit deeper. All right, our quick Groundhog update. No special reason for this other than to point out that I have once again disappeared. Just not,
And I have once again not gotten up there.
not appeared. But we do have, and it's worthy of notice, Nick DiVirgilio in number 6. He is rapidly climbing this list. I think he's in the audience. He's certainly going to be listening to it on audio recording later if he's not. Nick is on the move into the top 10 and charging hard. But yeah, the number of clubs continues to be fascinating.
It's interesting that Mid-Michigan has now put a lot of space between the other clubs, hasn't it?
Yeah, they've drifted up a little bit there.
Just keep on moving there, you know?
Yeah, Warren Buffett continues to lurk. Einhorn is still in the number 1 rhino position. The Manifest Investing Roundtable still checks in at 23, but there's just a whole bunch of names and faces that we really love.
And you can't say that experience as a director doesn't help you in this kind of endeavor. I mean, there's Joan Fosdick at number 11. There's Marty Eckerly at number 14. These are experienced, better investing directors, and they certainly know their way around a stock picking contest. You have to tip your hat to folks like that constantly, continuously, are sitting in the top 25, the top 30 as well. I see Saul is on the top, is in 26 there too. So we have a lot of our experienced people sitting up quite a ways on that list.
Well, what Ken is unsuccessfully trying to say is that if you look at the long-term results, people like Herb Lemkool, he's always been among the leaders with himself and some of his clubs. And you mentioned Saul Seinberg. Yeah, it's just kind of cool to watch, especially when you look at the long-term stuff. It's not an accident. All right. Let's go ahead and switch into the one-hit wonders, what we're going to talk about here for just a few minutes. It's a little bit of reminiscing and nostalgia about selections made over, like we said, over the last 11 years. These are the loneliest ideas that failed to receive either a voter selection by the audience or a follow-up selection by any knight or damsel. They were one-hit wonders in the true sense of the word. We want to look at what can we celebrate, what can we lament, and what might we learn from some of these. And oh, by the way, the average relative return for these selections is 5.5. So that's nothing to sneeze at. And that's actually fairly consistent with the general population of roundtable selections. Okay, are you ready, Ken?
Well, I'm ready, Mark. And what I did was, when I reviewed these slides and everything, was I made myself a vow that I was going to try to remove at least one of my of my one-hit wonders, remove at least one of them from one of these lists by choosing it again. So okay. I'm going to be very careful to kind of watch some of these. I notice on this list, for example, MWI Veterinary. I chose it once in 2011. We sold it in 2015, and there it is sitting with a 23% relative return. Obviously, it was something we probably should not have sold, and obviously, I probably should have chosen it 3 or 4 more times before I let it just sit there and get bigger.
Yeah, but it's hard to argue with that one-time pretty good bump. And what I find fascinating is everybody's pretty much got one of these. Now, I have to say, I think it's fair to say, Ken, that amongst the 4 nights, I'm the one who goes shopping outside the portfolio probably the most often. So my population of, one-time selections is probably higher than most, but I am happy that.
Did you just say you wander around on the edges more than most of us do? Is that what you just said?
Well, what else is a blind squirrel to do? But
We all have our strengths. And I have to say, Mark, yours is wandering.
wandering is a good thing. So, but what I find fascinating is look at everybody's on this list. I mean, Kim, that's a fairly recent selection of DXC technology. And as I recall, that was a student inspired pick. Is that correct?
I'm trying to remember.
Pretty sure it was from one of the student stock picking contests.
Okay. Yeah.
Hey, it was your idea.
Oh yeah. I mean, you've heard that term brain fart, right? You don't remember where you came from?
All right. But no, some pretty good picks on there. So these are the ones we smile about and thoroughly enjoy. Fortunately, these outnumber and dramatically outweigh the other end of the spectrum, because this is the good news slide. Here's the less good news slide. And I hold down the top position here, which is actually the bottom position. And I actually want to go back and kind of echoing what Ken had to say, take a look at Under Armour in greater detail. I've thought about doing this several times because I think it, over the longer term, it has been a fairly rewarding investment. My timing was just awful on this one. And the other thing I did want to point out before turning it over to you, Ken, is Iconix brands on here. It will be hard for a company, because of our new rules on selling, to end up on a list like this, because we do limit and exit a position when it falls 20% behind the market. And the poster child for that was our selection of Iconix brands back in April 2015, sold at a 24% loss just a mere 4 months later, and well, actually 3 months later. And it basically inspired us to take a look at some better selling disciplines at the time. But some of these are early works in progress. And again, most everybody's on here, but I've got a number of entries on here too.
And Mark, there seems to be a natural break between Stella Jones and AbbVie. Things move up a point at a time, 2 points at a time, and then suddenly that's a 4 point plus jump. If I were back in my teaching days in grading, I would draw a line there, because that's a naturally occurring break point between two different grades, whatever they would happen to be.
Mm-hmm.
But I'm saying to myself, from AbbVie on down, some of these stocks are still within 1 or 2 days trading of having a positive relative return. I mean, we've seen this kind of movement in some of these stocks after 2 or even after a day in some cases. So this is not really as bad a list when you consider that half of it, just go down from 10%. Half of it is 10% or less behind the market right now. Not too bad.
Yeah, and keep in mind that the ones that are in yellow, shaded in yellow, are closed positions. That's why they don't have an end date. The white ones are open. I do want to complain here, Ken, because, and this will fall into the category of whining. I feel like I'm right about Stella Jones. I mean, look at the price of lumber right now. Yeah, the company's been well positioned over the years, and I just feel like I should be winning that one. So sometimes you don't get what you deserve, I guess. This is part of the story there. Sort of like that time in the car when I was right about the VIX and I still lost money on the transaction.
Yeah, your name does appear on this list quite a bit now that I counted by names, Mark.
I thought you might enjoy that. All right. Let's take a look at a different slide, because my name's on that one far too much. I just wanted to go back and look at the ones, and here's a word from the field of education: most tenured. The companies that have actually been in the roundtable portfolio the longest, that are one-hit wonders, and this is where you might go to work, Ken. SEI Investments and Costco Wholesale hail from the first couple months of the roundtable back in the summer of 2010. And I'm certainly not going to complain too much about 13% for SEI investments. That's a pretty good result, even if it lags the market by just a tiny bit. But notice that Hughes kind of knocked it out of the park with Costco Wholesale. And I don't know how many times I've been tempted to pull the trigger on getting rid of Roche Holdings. And again, it's failing to beat the market, but still, a 13% return. To me, that's nothing to sneeze at as a kind of an integral holding within a portfolio. And I don't know how many times Cy Lynch told us just to chill and wait for global payments to do well, and he was right.
Well, I wonder how much that also has gotten better, Mark, because Global Payments bought out TSYS.
Right. So some pretty good performers on there, top to bottom. Notice that if you take these an average amount, they beat the market by 4 percentage points with an average annualized return of 16.8. So these are, again, the ones that were held the longest. Many of them have done quite well. Even the ones that have disappointed, you can't claim a whole lot of disappointment. I will point out to the audience that Ken is holding down the worst performer on this page. But he's not alone in that one either. Schlumberger has been...
Well, yeah,
Yes.
you're going to have to give Schlumberger and anything in the energy pass a pass at this moment. That was just a 2013 call, huh? Okay.
Yeah, I mean, how frustrating. This is the definition of world-class company in that field. No doubt about it. And just, to have an annualized minus 11. And I haven't looked at the price lately. It probably has jumped up fairly significantly here over the last few months from 40, where it was at 44 back in 2019. But again, I feel like I've been cheated on Stella Jones here. Might have to hang on to it just to see if things improve, but it's a formidable list. And again, part of the message is there's some of them on there that probably would have been worth returning to. I know that I thought hard about extra space storage a couple times. I am stunned and amazed that Hugh McManus didn't go back for Eli Lilly, at least once or twice or three times. And how about Mercado Libre?
Yeah, that's one we talked about for a couple of years, Mark. I can remember traveling and being in Minnesota and talking about Mercado Libre at length, and yet we just never seem to have the courage to go and pick it. Look at that return. Look at that return. Yeah.
Yeah, and it's had its moments. It can be quite volatile. And, and Kim comes out of the woodwork with a race car every once in a while, Formula One there.
The only thing you two know completely, to be sure, is never expect the normal from me.
Well, that's a pretty good result, too. So, again, over the years, one-hit wonders, why don't we go back? Something to be thought about. And look at Herb Lemkool up at the top of the chart with Tyson Foods. Again, not beating the market, but certainly within striking distance, with plain old Tyson Foods. So good, clean fun. All right. Let's switch gears and talk a little bit about the most widely followed company at Manifest Investing. I think that's probably true for Better Investing. Does Apple? It's got to be near the top of the Better Investing 100.
It's certainly in the top three, Mark. I don't know if it is number one, but it's certainly in the top three.
And just the nutshell pick, I mean, you guys can all read the chart. You see up straight and parallel, even for a company that has the opportunity and likelihood of volatility in many aspects of its business. But look at that earnings line over the years. I mean, you can't get much better than that, considering the realm that they live in. And here's the trail end of phones becoming computers. I never would have dreamt that my phone would become the computer that it is today. Going back into that time frame. And I don't know how many times I talked about the PE of Apple really belonging closer to 10 than 20, and look where we're at today. With the price, I would consider that one an outlier pretty much, but still, we're looking at upper teens for a reasonable PE for this company. So if you look at value line, you'll see growth rates of 12.5 to 14.5% for the top line growth for the company. If you actually do a regression through all of the numbers that are shown on this chart, you end up with 9%. I think 9% makes a whole lot of sense. Notice how it catches most of the points on the historical and the projected trends for the company. A little bit of flattening here. Again, these are going to all be analyst consensus numbers, so there is a little bit of flattening, so a little bit of concern there, but nothing too terrible. The projected net margin, wow. Section 2A on a stock selection guide basically looks quite strong. Strong profitability for a company of its ilk. Again, the PE in the low 20s, you could even knock a couple of points off of that and you'd still be okay over the long term. Notice that the projected annual return is floating in that 5 to 7% range here over the last quarter or so. That's a decent number. Again, the average stock is somewhere between 6 and 7% right now. Very high quality company. That quality rating or ranking is built on the strength of a balance sheet that is almost unequaled. The straightness of that earnings per share line. You know, I mean, the only place where they get dinged a little bit, and that's natural for a large company like this, is on their relative growth compared to their peers, other technology companies, and their profitability is just, again, quite strong. Upside downside ratio in the hold range. You can see that they are managing their balance sheet pretty well. We do love it when these projected return on value numbers line up and reconcile fairly well with the projected annual return, and they do in this case. These numbers all seem to make sense. They do have a whole bunch of cash in the checkbook. Amazingly enough, they continue to take on debt, which at some point I guess becomes an issue, but they still have almost as much money in the checkbook as they do in their mortgage, so it's not something you get terribly concerned about. The long-term low return forecast, again, that's the low expectation, is down around 3%. So again, pretty solid from top to bottom. Not one that I would rush out and buy, but I certainly would wait for a spike downward, buy the dip, so to speak, opportunity, and pretty good from top to bottom. Your thoughts, Ken?
No, I've been answering a couple of questions in the background here that I'll tell you about in just a second, but I certainly understand what you're saying. Mark, we're getting a number of people wanting to know, can they get these kind of charts somewhere, or is this something you've made up yourself here?
Well, what you're looking at is just an extrapolation from the old Jim Thomas, Doug Gerlach SSG reader. So it's actually a Excel file that can read a data file. Now it has been modified, but yeah, we've made them available a number of times. In fact, we had a bull session dedicated to this almost a year ago now. So I'll put something in the show in basically in the notes that'll link back to that session for how you fill them out and make one of them available there, and you can take it from there. Now, what I will say is you have to have some familiarity and courage when it comes to spreadsheets. I don't have the time really to turn everybody into spreadsheet warriors. I am not a spreadsheet warrior, believe it or not. So you can watch that video and use it manually to actually walk through these numbers. Often I'll get the question when it comes to this spreadsheet, there's actually a data field below it, just like on a stock selection guide data field. Why go through the process of doing it manually? Now, part of it is to actually crunch through and visualize and see the numbers, touch and feel the numbers. Now, there is a version, obviously, for us at Manifest with our linkage to the Y-charts data. We can actually populate these using that. I can't make that available. So the sheet that you'll be looking at doing will be, a manual version of that. I might play around with pulling in some SSG data if I get brave, Ken.
But add it to the list, Mark.
But I do find that it really walks me through what I have come to believe are some of the most important characteristics, especially when you start stacking these up quarter to quarter or year to year, and watching how the capital structure might be shifting around. Like, I think it's kind of cool to realize that Apple has reduced their total liabilities by $20 billion. At the same time, they only went down $7 billion in cash. If you're following along with that, so that's got to be a pretty good situation. They did borrow a little bit more, but again, the interest rate on it is pretty attractive for a situation.
I think the most powerful thing on a sheet like this, Mark, is the side-to-side comparison, and the fact that you could add a third and fourth and fifth and as many columns as you want if you really got into it, and keeping an eye on those trends many times is telling you as stuff that's as important or maybe more important than some of the individual numbers that are there.
Yeah, and as we got into it with the projected return on value, keeping track of what the company is doing with its debt, not just its equity part of its capital structure. And oh, by the way, these guys continue to buy back stock. In addition to the numbers that you see here, they continue to take stock off the table. So that's all a work in progress also. So yeah, it's an opportunity. I will put a series of stuff, and we will dedicate a future session to demonstrating and answering questions about preparing these.
Mark, could you walk back 2 slides, 3 slides, please? 1, 2, 3. 2 more.
2 more?
2 more, yeah, right there. Mark put an arrow by MWI Veterinary because it was the one that I was talking about, and I really had wished that I would have put more choices into that at that time. A number of you immediately, evidently, went to the internet to look for it, and you couldn't find the company. That's because in 2015, this company was bought out by AmerisourceBergen. So a company goes inactive in the roundtable portfolio, and that's the significance of the yellow background on this slide and the next 2 slides, in fact. So this is no longer an active holding, and it wasn't sold out of the portfolio. It was taken out of the portfolio because it was purchased by somebody, and it's not a private company anymore. MWI still exists, but it's a subcategory in AmerisourceBergen, and that's not traded publicly.
Okay.
So we had that's easier for me to explain that than it is to write that all down in a response to a question.
Yeah, many of the shaded in companies were, Intelliquent as an example of that. Pretty sure PetMed Express the first time around also were actually, private equity or acquisition decisions, and probably Camping World also. But the other ones are predominantly sell decisions in the portfolio.
Yep.
All right. So that's your update on Apple. And for those who are curious about what are the 40 most widely followed stocks, along with their key characteristics, you can see the top 40 here from Apple at number 1. This group of 40 stocks was actually first established in September 30th, 2005. So if they show September 2005 for their added column, that makes them a charter member of this group of 40 stocks, and they've been there ever since. You can see about half of the 40 have been amongst the most widely followed companies since 2005. So we're coming up on 16 years, and they've been in that group. A company like Apple came along about 4 years later, and it's one of the most amazing things to watch when our community begins accumulating a company like Apple. In other words, it was not in the 40 back in 2005, and then suddenly it appears in 2009 being added to the list, September 2009, and then we watched it steadily climb up the Manifest 40 into the pole position. Other companies that have been at the top, one of them was Stryker. I don't know if Microsoft was ever up there, Ken, if you happen to remember, but I know Stryker was.
I don't know if Microsoft was, but I know Cognizant held the top place for a while, Mark.
Okay. So Cognizant was a number one, so was Stryker. And I could swear there was another, might have even been Cisco Systems. I don't know for sure about that, or Microsoft. So anyhow, Apple knocked whoever it was out of number one, and it has continued to stay there. Notice that the annualized return on, in fact, the relative return on Apple has been 16%. The overall return closer to 31% over 10 years, in more than 10 years. So it is kind of fascinating to see companies bubbling up like that. The one that I guess I would point out here is this one. Our community woke up. Hugh McManus was definitely out in front of this several years ago, but the accumulation of Amazon by the community has been, at least from an interest perspective, following Amazon has steadily increased, and that's been quite rewarding if you were in early enough. And again, that analysis we were just talking about for Apple, if you go back and do that on Amazon or Tesla, you can take an ownership position in companies earlier in their life cycle using that as a technique, and we will talk about that more and more. I do find it fascinating, Ken, that Visa has climbed up here into the number 5 position. Facebook has continued to climb up the list, even though my wife and I sold our position in Facebook just because we were mad at them. Let those emotions roll. The only other one that I wanted to bring up here was General Electric, something we'll probably spend some time talking about in greater detail. They announced a reverse split this week that will happen on July 31st. And I don't know if you caught that, Ken, since you've been rolling in the woods.
I did. Isn't it 1 for 8, right?
Yeah, 1 for 8, and that's usually a pretty desperate situation. I can't believe they're doing 8. That's going to put the price up above 100, but I guess they needed some breathing room. I guess we'll have a future session on what a reverse split means, and it's generally not good. And we'll ask the question: is it different this time? A future session for General Electric, because that's been one of the most annoying investments in my career of investing over the last several years. All right. Any other comments on that, Ken? Anything jump out at you?
Are those? Yeah, that Home Depot going from spot 23 to spot 14.
That's
probably one of the largest movers that we have on the whole list.
Yeah, they have been strong for the last. That's fairly recent.
Yeah,
that drift. But it has been on the list. It's not a charter. I think it was a charter. It fell off the list and came back in 2014. Interesting.
Certainly a nice move.
So again, we look at this and we have to believe that this is representative of the type of companies in most of our community participants. What do they actually own? We think this would be somewhat representative of what is seen there. And to see this group of stocks actually generate a 12% annualized rate of return is a good thing. We do like to see that. And if I had a wish, it would be that some of these companies, now I would give Gilead a pass as a non-core, but some of these companies are pretty tired with fairly low growth rates. It wouldn't break my heart to see them disappear from the list so that this number actually increases a little bit. Time will tell. All right. Any other thoughts, Ken?
Nope. Interesting list, though. Very interesting, Mark. Oh, there's our bridge again. Okay.
Your bridge is back, and they actually meet this time.
Right.
I kept this one in here just for you, Ken, because you were wandering around in the woods last week, and I had answered a few emails from participants. Again, the point being that our tools basically represent that bridge when we get into economic chaos and turmoil, turbulence, and confusion. If you stick with pictures like that, the bridge is the red dotted line through all this stuff, everybody. And then that actually transcends into this picture. And all we're doing with what we described 3 weeks ago now at the round table or at bull session was all we're doing is calculating the difference between the actual numbers and the trend lines, and basically kicking in the use of the trend line, basically kicking in the use of the trend when it makes sense to do so, that being when the difference gets large. And that's all we're doing with the data at Manifest as we described it with the economic drift calculation a few weeks ago. So I thought you might enjoy seeing that, Ken, presented in this language. All right. Here's a quick reminder that we keep all of the bull sessions and the roundtables and the successful investing conferences, along with anything else that we might dabble out with respect to educational topics in investing at YouTube. You just simply can search for Manifest Investing at the YouTube channel. We'd really appreciate it if you subscribe, and that way you get automatic notifications, pushes when we or nudges when we post new content. And with that, I don't think this is one of Kim's sunsets, but it could be.
And I don't think it's one of those.
Okay.
No.
Well, somebody keeps sending me sunsets, and I know you have in the past. Yeah. Although yours had a pina colada in it the last time you sent one.
Yeah, that was good.
All right. So with that, Ken, I think we can say thanks, everybody. We'll see you in another week, a week from today.
You've turned off the recording, Mark?
I'm going to go ahead and shut it down as soon as I can get to it. Shutting it down now. Thanks, everybody. See you soon.